Today's guest is Dr. Daniel Crosby, who wrote The Laws of Wealth. We are going to dig deep into money psychology and why we behave the way we do. Welcome to Richer Soul, Life Beyond Money, The Last Baby Step. Imagine it's 12 months from now, and you've achieved your major goals. How does it feel to be in the best shape of your life, to wake up energized, excited about the day? What is it like to have great relationships and friends who support you? How does it feel to have an excess of money, to be able to do and make the choices you want? Imagine being connected to the universe and having it provide everything you desire. Your past does not dictate your future, and the only thing holding you back from this vision is you. If you haven't had a chance to listen to episodes 1 through 9, I encourage you to go back and listen to the framework behind Richer Soul and how to create balance in your life. I help people live the life of their dreams, and you can hear how on richersoul.com by looking under the Coaching Call tab to hear actual coaching sessions. You can also find all the show notes for this episode on the website. I send out a monthly email, and you can sign up while you're there. In the short monthly email, I share the best articles I've read this month, let you know about upcoming episodes, and share a little wisdom I learned this month. I also share the most interesting articles I read every week on Facebook at facebook.com/Richer Soul. It's harder to keep wealth than it is to make it. Once you come up with a system to create wealth, you then need a system to keep it. If you'd like a second opinion on your financial plans and systems, or are worried that you're missing something, check out the SWOT analysis: strengths, weaknesses, opportunities, and threats. You can find it at richersoul.com/SWOT. You need to connect your personal why to your financial goals. It takes a long time to create success, and you need to have the grit to be able to achieve that. If the plan is not tied to your purpose and goals, it's going to be hard to stay the course. You need to focus on your financial success and goals because no one else will. I belong to a lot of financial forums, and I constantly see the same issues coming up. People are asking tactical questions, like, should I put more money into a 401k or a Roth IRA? And what's the order of how I should contribute? The reality is, I don't know your goals and desires, nor does anyone else. How can they answer a tactical question unless we do? In this case, you're essentially following someone else's plans, and who knows where it will take you. Be clear on what your goals are, and then the tactical plan and the tactical questions become much easier to define, measure, and get the best feedback on. Today's guest is Dr. Daniel Crosby, who was educated at Brigham Young and Emory universities. He's a psychologist and behavioral finance expert who helps organizations understand the intersection of mind and markets. Dr. Crosby's first book, Personal Benchmark, Integrating Behavioral Finance and Investment Management, was a New York Times bestseller. His second book, The Laws of Wealth, was named the best investment book of 2017 by the Axiom Business Book Awards and has been translated into Japanese, Chinese, and Vietnamese. Let's meet Dr. Daniel Crosby. Welcome to Richer Soul, Daniel. It's great to have you join us today.
Thanks so much for having me. It's my pleasure.
It's going to be a lot of fun. I am very much a fan of behavioral psychology in finance and why people make the choices they do. Before we get to that, let's start at the beginning. What was it like when you were growing up, and how much did your family and school teach you about money?
So I had a little bit of a head start, a profound head start that way, perhaps. My dad was and is a financial advisor. And so I think unlike a lot of American households, during that time, we talked a lot about money. I didn't learn a thing at school. I mean, I think pretty consistent with the rest of the world. I didn't learn much at all about personal finance or investing at school, but had a dad who was very into it, who was very vocal about what to do and what not to do, had some very specific ideas. The word debt was considered a 4-letter word in our house in the very most literal sense. Like, you couldn't say debt just the same way you couldn't say other 4-letter words. I remember being a kid and just years at a time of eating beans and rice for dinner every night because my parents were trying to pay off the house. My dad paid off the house when he was 35 years old. And so, really, really working hard to get out of debt, to be proactive about setting up a wonderful financial future. So I was lucky in that respect.
Maybe you left a clue there, but how did he learn to do that? It almost sounds like a Dave Ramsey kind of story.
He grew up poor. It's just sort of a simple case. It seems hard to tell. Some people grow up a certain way and then they perpetuate the things that they learned, and other people react violently against them. My dad grew up with not a lot of money, and I think he just wanted different things for his family, pulled hard in a different direction. And to this day, he's an advisor, and he's a great one.
Well, congratulations. You were lucky.
Yeah, I know. I do feel lucky.
So with your background in psychology, what are you doing to create the right mindsets in your kids about money?
Well, my daughter, I have children who are 8, 4, and 1. And so my 8-year-old daughter, I was getting her ready for school the other day. I was cleaning out her work folder, and there was a paper, sort of like a what I want to be when I grow up paper. And the paper started, "Did you know that most Americans are totally unprepared for retirement?" And then it goes on to talk about how she wants to be a financial advisor. And so I guess I'm doing something. I mean, I haven't been very intentional, to be honest, about doing any sort of formal financial education, but clearly it's on my mind and it's on her mom's mind, and we're talking about it at the dinner table because it's getting through to her, because it was hilarious to see some of my own talking points, parroted back in this "what I want to be when I grow up" paper.
And I've always kind of said kids don't listen to what you say, they listen to what you do. And you essentially are doing it, and so they're listening to that, probably.
To give myself maybe a little credit, my wife and I both look for teachable moments. Something as simple as being out to dinner. We talked to our kids recently about tipping and the need to leave good tips. And my 4-year-old son, we were at a sort of a fast casual restaurant, and he said, "Did you leave them a tip?" Yes. And he said, "Well, do they make more money than you, or do you make more money than them?" And so sort of talking to him about, what different jobs pay and the need to be good to people who work hard for a living. And anyway, so we're always looking for sort of organic ways to have that conversation. It seems to be sinking in a little bit. That makes me happy.
That brings up a question, because I know a lot of my guests, it's one of two things. They were lucky and they had parents who kind of at least talked to them and gave them some direction. For a lot of people, and just in society in general, it seems to be, or maybe it's American society, talking about money is taboo. What have you found in regards to that?
Yeah, I remember some research I did for one of my first books, and someone made the point, I'm going to forget who now, that barely any couples get married without having some sort of physical intimacy or physical contact. But lots of couples get married and never have any sort of financial intimacy or any conversation around money, because it's sort of the last taboo. I think we talk about race and sex and religion and everything else, I think, a lot more freely than we do money at this point. So I think it is, in many respects, sort of the last taboo. There's been a strong reaction in the past few years, sort of consistent with the conversation around the real problem around wealth inequality. I think it's become problematic for some folks to even show that they have money, or to make it known that they have money. it's a problem that's not getting a lot better, when I think other sort of sensitive topics are maybe we're getting a little more free with the way that we talk about them. I think money remains very, very verboten.
Huh. That's funny, because I know I've been married for 22 years, but my wife and I had money conversations when we first got married. It was part of the things we talked about. And maybe that's why we've had money successes, because we had the conversations. It sounds like you had conversations with your dad. You're having conversations with your kids. And it's not that money is good or bad. You can use money for evil, but just having these simple conversations can help to educate people and maybe change that future for them.
There's no doubt. My father-in-law is an accountant, and so with the financial advisor on one side and the accountant on the other, I feel like we're sort of a skewed sample with respect to how top of mind money is. But yeah, I still think a lot of folks don't discuss it. I remember even when choosing a major in college and things, I would look at how much different jobs paid, but I didn't have a sense of what that sort of looked like or felt like. I didn't know what my parents made. I didn't know sort of what was average, what life cost. Looking back on that, even as a graduate student, I feel like I was very naive about how expensive life is, how expensive family is, and I feel like I could have benefited from more there.
So do you plan on sharing your personal financial information with your kids?
I do plan on it. I feel like more people should talk about it. I think we should give our kids a sense of what to expect. A fish doesn't know it's wet, so I feel like people sort of ascribe normalcy to whatever financial environment they grow up in. Your idea of normal has a lot to do with sort of how you grew up. It's a good idea to give kids a sort of idea of what they came from, what it costs to live like that, and, you know, the sort of jobs and opportunities that will put them in a similar ballpark. And then the sacrifices on either side of that, you know, the sacrifices that you might make to make a lot more money, or what you might give up if you made a lot less. I think it's good to have all of those conversations.
And I think that's important distinction. A lot of people don't realize what you have to give up to make a lot of money in most cases. They don't realize the amount of work, effort, and time that goes into that, and the costs associated with being rich on the other side.
I had my best year ever about 2.5, 3 years ago, right? I remember getting to this time of the year, that year, sort of taking the holidays to look back and reflect and reprioritize. I said to my wife, I'll never do that again. You know, we will never have a year this good again, because I'm just unwilling to do what it took to make that much money. We've made different plans, and you look for ways to scale it and work smarter and things, of course. And that's always something I'm trying to do, but there's a big trade-off. I find the job market to be relatively efficient, in the sense that there aren't a lot of jobs that pay very well, that don't ask a lot of you. In a lot of respects, people who get paid a lot because they do hard work, or they're gone a lot, or something. There's usually a cost, not always, but there's often a cost.
That is very true. So you've written many books. I think the last one is The Laws of Wealth, which I think originally had the title Stupid, Lazy, and Rich. That's
right. My prim and proper British publisher would not let me get away with Stupid, Lazy, and Rich. That was my initial suggestion.
So when you update it, you know, with the American publisher, you can go with the second title, and it probably will make you millions.
Here's hoping.
In there, you have 10 rules. These are quite interesting. As we go through them, I'm going to admit to them all, because I think I've done most of them. Let's start off. Rule number 1 was you control what matters most, correct?
That's right. I picked this rule because I was very intentional about the ordering of this rule, because I wanted to empower the reader of the book to say, look, more a better predictor of whether or not you'll reach your retirement goals is just simple blocking and tackling behavior from you, like how much you're setting aside. Are you managing your fees? Are you managing your taxes? Are you doing simple things, right? Are you automating your investing? This is a better predictor than all of the stuff we worry about. This is a better predictor than what Donald Trump does or what Mario Draghi does or, what Kim Jong-un does or whoever. Before we worry about the complicated stuff, let's own up front that our behavior is the best predictor of our financial success.
In there, you said one thing. So this is one rule I did well with. I automated my finances from the moment I graduated college and got my first job. I automatically started sending money to all these different accounts. I got my 401k. I started sending money to the credit union. I started sending money to the stock plan. And then I had an after-tax brokerage account. And I started sending a little bit of money to all of these different places. And every time my income increased, I just kept sending them more money. It was little by little, and it was slow at first. It took forever. But over time, it snowballed. Now that I look back over 30 years, that simple choice, in spite of all the other stupidity I've done, has allowed me to become a multimillionaire. Because in spite of myself, that basic rule of just paying yourself first, automating it, and never touching it, essentially made me stupid, lazy, and rich.
Yeah, well, that was why I chose the title. I mean, you can really overthink these things. Some of the smartest people in the world overthink these things to the point that it's difficult for them to make good decisions. And I've often thought, I wish I didn't have to be so immersed in the day-to-day of the markets just because I'm called on to give commentary and to give speeches and things. I would make better decisions if I were more removed from the day-to-day of financial markets. And so, Nobel Prizes have been given out. Richard Thaler, behavioral economist from the University of Chicago, just won a Nobel Prize for his work on the two things that you did quite intuitively, which is auto escalation and auto withdrawal. Basically, automatically take that money out every month, and then when you start to make more money, you increase the size of those contributions. And so, his work around those two things has saved Americans tens of billions of dollars in extra retirement funds, and he just got a Nobel Prize for it. So you were onto something when you were doing those things.
Unfortunately, I didn't get the Nobel Prize. I should have learned to write better.
The Nobel Prize comes with $1 million too. That you could have added that to your other millions.
There you go. Well, at least we're telling the next generation how to get ahead.
That's
so,
right.
Rule number 2, you cannot do this alone.
Yeah, so the second rule, I talk about the importance of having behavioral guidance. I sort of lay out the power of working with a financial professional to help you make better decisions. And I make the case with a drawing on a variety of research that shows that people who work with a financial professional do 2 to 3% better per year than those who don't. And not because they're picking better stocks, but just because that individual is helping them from making a handful of backbreaking poor decisions over an investment lifetime. And so there, I'm really trying to make the case for the highest and best use of an advisor or another financial professional is not to pick great mutual funds for you or to give you the next hot dot, but it's rather to be your coach and your guide and to save you from yourself.
Early on in my career, I didn't have someone who did this, and I would make lots of stupid decisions. I would always be chasing returns. And even as late as 2008, when the market crashed, I sold out at the bottom because I made a stupid move. But I have a question, because this is where I struggle. A lot of financial professionals are nothing more than salespeople for particular firms. And so how much are they helping behaviorally, or how do you find, that's the question, how do you find the best person who can help you behaviorally make the right decisions?
So these are made up statistics, but they're consistent with my observations, right? So there's 10% of investors that are just degenerate gamblers who are never going to be helped by anyone who just are adrenaline junkies and are just going to, buy penny stocks and do crazy stuff and, live or die on that high risk, high reward type razor's edge. 10% of people probably don't need to work with an advisor. I mean, 10% of people can manage their own behavior and are not prone to greed and fear to the point that they are probably fine to do it themselves. They're probably fine to use a discount brokerage and automate it and just leave it alone and never touch it. But most of us, and this is advice for the masses, most of us benefit from working with an advisor. And you're absolutely right that about half of the advisors in the country work for firms where they don't have to act in your best interest. And so in the Laws of Wealth, I have a 10-part checklist where I say, look, you need to work with an advisor, but not all advisors are created equal. And so here are some of the things you need to look at when selecting an advisor. And my wife, who doesn't work in the financial services industry and isn't super interested in these things, read my book because she's a good sport. And, I asked her, what was the most valuable? What do you feel like you learned? And she said that checklist, if I got hit by a truck tomorrow, she's like that checklist is what she would take to find the kind of person that she wanted to work with. So it's tough because not all advisors are created equal, and yet we really need one. So I hope that checklist is a valuable resource for folks.
One of the other issues that comes up, and I think it's getting worse and worse, is an advisor is not paid to teach you behavior. They're paid under a variety of different ways, depending on where they are. And the problem is that the person who needs help the most is the young person who's just starting out, or the people with the least amount of money. They may not be able to get access to those type of people because it's not worth their time to talk to someone who's only got 10, 50, 100 grand.
That's absolutely true. And the good news is some of the more advanced technological solutions are beginning to integrate sort of simple behavioral elements in there. They'll sort of say, hey, are you sure you want to do this? Because it's got this consequence. So robo-advisors like Betterment has hired a good friend of mine, Dan Egan, who's a behavioral specialist, to try and embed, behavioral interventions in what is a very low fee, low cost platform. And so I think the whole industry is moving in that direction slowly but surely because, the person with $15,000 probably needs help more than anyone else, and barely any advisor is going to want to take that person on.
So the next rule is trouble is opportunity.
Yeah, so this is a rule that everyone thinks that they know and no one does, right? So the whole notion of buy low and sell high, everyone says it, no one does it. And I cite research in the book that shows that even professional money managers tend to do the very opposite. They tend to have their highest cash reserves at times when stocks have the most attractive forward returns, and they tend to be sort of levered to the hilt and very risky when stocks have the worst forward returns. So again, that section is really all about automating, and I draw on a couple of humorous examples there to show that we don't have as much willpower as we might like to think we do. And so that chapter is really all about sharing the research on willpower to show how limited it is, to show how quickly it's used up, and to make the case for, again, having that strong behavioral coach, having an automated solution, and trying not to make a decision under pressure.
And it's funny because I know I used to make this mistake a lot. And it's funny because I make the example of if I went to the store to buy bread and it's normally $3 for a loaf and it goes on sale for $1, I'm more apt to buy it. And if I go in the store and all of a sudden it's $5 today, I'm like, I'm not going to get bread today. But when I go look at a stock and the stock market's booming, everyone wants to jump in. And when the stock market's at the bottom, everyone's fearful. And I was thinking, like, why do we do this differently? And I think almost as the stock market's going up, it's a fear of missing out that causes us. Like, I don't have a fear of missing out on a $5 loaf of bread. But when everyone's making money, I think I have a fear of missing out that I'm not making money as well. And I don't know if there's other behavioral things behind that as well.
What's fascinating is, I believe his name's Charlie Biello. I hope I'm pronouncing that right. He's a gentleman on Twitter who's been running a survey relative to Bitcoin. And he's been asking at different price points, is Bitcoin a bubble? Right. And so he asked, at $1,000 and $5,000 and $15,000, is Bitcoin overvalued? Is it a bubble? Is it a bubble? And at $1,000, lots of people thought it was a bubble. And at $15,000, hardly anyone thinks that it's a bubble. And so it's fascinating. We infer quality from price. I wrote about pineapples in a book I have coming out late 2018. I wrote about the history of pineapples, and pineapples used to cost thousands of dollars a piece. And royals used to build temples and palaces in the shape of a pineapple because it was so costly and esteemed so highly because it was so rare and it was so costly. Well, now you can go get a pineapple for $1 or whatever they cost down at the grocery store, and no one is all that excited about pineapples now. And so we use price as an indicator of quality, and that's one of the reasons we do exactly the wrong thing in the stock market, because the more expensive things get, the more valuable we think they are, when exactly the reverse tends to be true in the stock market.
It's funny you say that, because I remember reading a story in a behavioral psychology book, and it basically said that it was kind of like a tourist shop, and the lady had this jewelry, and she was going away, and she just told her coworker that was behind, hey, just mark all the jewelry down by half, and let's just get rid of it. It's not selling. And she went away, and she came back, and it was all sold. And she said, that's wonderful. The sale went well. And then she realized that the person who she had told to do it made a mistake. She actually marked everything up to double instead of cutting it in half. And by doubling the price, everyone thought it was more valuable, and all of a sudden everyone was buying it.
I tell a story. I don't remember where in the book this is. I may be telling stories out of chapter turn, but I tell a story in the book. I do a lot of public speaking. And back in the early days of my public speaking, I gave what I thought was a fantastic performance. I got off the stage, and the sponsor came up to me and said, hey, great job. There's just one problem. And I said, well, what's the problem? I thought I just killed it. And he said, well, everyone back at the home office thinks you suck. And I said, well, how do they think I suck? And he said, your prices are such that when they see what you're charging us, they won't bring you in because they just assume you're no good because you're charging X. And I doubled my prices the next week, and I've since then, nearly quintupled my prices. But, I doubled my prices the next week because I hadn't learned my own lesson about price being an indicator of value elsewhere in the world.
And so that's funny, because my daughter is about to go off to college, and I've talked to people on the inside in colleges, and literally colleges do this. They have to raise the price of tuition and then play the scholarship game, because if you go to a college and they're only charging $25,000 versus $50,000, you go, this college sucks.
Right. Yeah.
And so they've had to double the price of the college, and then they work on giving you scholarships and doing this and that. People have to realize, if you can get something for a deal, get it for a deal. The price has nothing to do with the quality. And that's especially true in the world of wine. The next rule, if you're excited, it's a bad idea rule.
Yeah, if you're excited, it's a bad idea. So here I sort of try and make the case that good investing is sort of, for the long term, it's slow, it's boring, it's unsexy, it's probability based, it's not story based. And so I give the example of some sort of exciting types of trading and investing that tend to be a bad idea. I give the example of day trading, which there are, hundreds of thousands of day traders, but a recent study out of Taiwan found that only 1 in 360 day traders shows any skill. And so is it exciting? Yes, absolutely. Like, are there stories of people who have made big bucks doing it? Of course there are. But is it a bad idea? Absolutely. I also give the example of IPO investing and, share the research that IPOs have underperformed the S&P 500 by 21% in the first 3 years of their existence. Now, it's exciting to be early on. It's exciting to be early to the game, but it's a bad idea on the whole. But everyone can point to an instance where, if you had invested if you had invested $10,000 in Apple or LinkedIn or whoever on the day that they IPO'd, you'd be fabulously rich now. But one of the things that you have to do as a behavioral investor is just tilt probability in your favor and not rely on stories, but instead rely on the less exciting, but more probable. So if you're excited about it, for the good or the bad, it's probably not a great call.
That's tough because when we get excited, we make decisions. It's like, it's fun at that point. That's the hardest thing I think I face in the retirement plan is that I'm just waiting. You've got to wait for your money to double. I'm just waiting. I don't have to do anything. I want to do something, but it's just enjoying that journey while you're waiting. I know I got involved in Facebook, but what I did when I bought Facebook is I let it IPO and it went up and then it tanked. And then I waited for it to come back up. And then I tried to figure out what their model was. And once I understood their model and once I saw that it had recovered from all the hype, I got in and it's done really well since then. So how do you shift probability and what exactly do you mean by probability?
That's the whole second part of the book is talking about a specific way to tilt probability in your favor. So it's talking about buying inexpensive stocks, talking about buying high quality stocks, talks about ways to vet stocks for unnecessary leverage and bad debt and bad leadership and things like this. And so the way that you do it is buy a diversified basket of cheap, high quality stocks with good leadership. And I talk about that in some detail in the second part of the book. But just, chapter 5, we'll fast forward there a bit. Chapter 5 says you are not special. And tilting probability in your favor means that you're prone to all the same, fear, greed, panic, and idiocy as the next person. And understanding that the best that you can do is to diversify, take a long-term approach, and try and gain an edge here and there by maybe buying a cheap stock, buying a high-quality stock. But realizing that get rich quick and get poor quick are sides of the same coin.
And I know I made that mistake quite a bit early on. And I still kick myself for not buying Berkshire Hathaway when it was down around $5,000 a share. I thought it was expensive. Had I made that investment, another few $100,000 in the bank. Oh, well. So the next rule is your life is not the best benchmark.
So your life is the best benchmark.
Oh, I'm sorry. Your life is the best. I missed that one. Good. You're listening.
Yes. Your life is the best benchmark. So here is where I make the case. People who have access to, daily benchmark returns, S&P, NASDAQ, whatever returns on their iPhones, we hear about it on the drive home, on the radio, you see it on the TV at the gym, but that's not the benchmark that we are trying to beat. So what I'm encouraging people to do here is really two things. The first is to figure out your own risk tolerance and the rate of return that you need to live the kind of life that you want to live. Now, if you are, a modest, humble person and, big houses and fancy cars don't matter to you, you don't need to achieve eye-popping returns to get there, perhaps. And so finding where you're comfortable, finding out the kind of return that you need to live the good life for you, whatever that specific good life is, and then trying to achieve that level of return, setting up a portfolio to achieve that level of returns, not one that's necessarily going to beat the benchmark. And then the second part of that is to let the things that you're dreaming about, whether it's a beautiful retirement or sending your kids to college, let those things, those values, those dreams pull you along. Because, I share research in the Laws of Wealth about people who look at a picture of their children before they made a financial decision, and they saved over 200% more than people who in the control group. And so I think that there are ways to introduce life and values and dreams back into the conversation. And that's the cherry on top that makes all the hard work of scrimping and saving and long hours and travel worth it, is really visualizing those dreams and the good life that we're going to have as a result of all of this.
That kind of comes back to what I said before, is you're sitting there waiting, which is kind of hard. I think most people look at that and say, well, I want the best possible return, and they don't realize that the risk is there, and that risk is probably what will prevent them from achieving that result.
Yeah, my buddy Greg Davies says you want the maximum anxiety adjusted returns, right? So you want the maximum returns that you can live with.
So that is one, and I've struggled with that one, because you think you can live with something until you're there. And that's what 2008 was for me. It was like, oh, I give up. I'm done. I think in previous times I had seen the bubbles. I just didn't realize that the real estate bubble was going to do what it did to the stock market. I wasn't involved in real estate at that point at all. But yes, that anxiety is very much real, and you've got to overcome yourself. That's a difficult one. So now I'm thinking, here's a great thing. Like, now this is the perfect thing. Teach your kids to use FaceTime, and especially when they're teenagers, you have to answer the FaceTime so you can look at them and ask them permission to buy something. And the carrot for the kids is, hey, listen, you have a choice. If you don't answer my FaceTime, I'm going to blow your college and your inheritance. So your call, make a decision.
Nice. I love it.
So the next rule is forecasting is for weathermen.
So here I kind of speak to the financial media aspect of things and speak to the more dramatic forecast-based nonsense that goes on the 24/7 financial news channels. I share research in that chapter that basically stock analysts have a 1 in 2 chance, so a coin flip chance of getting the direction right. So whether a stock will go up or down rather, and only 1 in 170 consensus analyst forecasts are within even 5% of the eventual outcome. So this is that time of year when we're going to be hearing all of our forecasts for next year. And so just to, give you a sense, the forecast for this year, I think the consensus forecast was that stocks would grind higher by about 5%. Well, stocks are up about 22% this year. So again, people are just basically extrapolating the recent past into the future. No one knows what they're doing. And it leads, I think, mom and pop investors to believe that there's more certainty than there is around these things. And so, nobody knows what's going to happen. And that sounds like a scary thing, but it sort of is freeing in a way, because it frees you from having to listen and tune in to all this nonsense. You can just go about your life, watch Thursday night football, automate the process of auto escalation and auto withdrawal, live your life, watch more interesting programming, and you're going to be just fine.
I was a CNBC junkie for years. And I think the smartest thing I did was to get rid of CNBC. And now I don't watch it. And now I don't worry about it. And now I have the conversations every 6 months to a year. But even then, I still struggle. So like right now, and maybe you can make some market commentary. Right now, the stock market is at the highest valuations it's ever been. Bond markets, same kind of thing, which is, it's unusual historically. And I know last year at this point, I was having the same conversation. I was thinking about going to the sidelines, and I kind of stayed in and said, let's see what happens. I'm here again. And I had the conversation again this morning. And the conversation was, at this point, I'm going to stay in because I just can't predict things anymore. And if I'm out, I'm not going to make money. So let it kind of ride. What are you thinking with the valuations that they're at? What are you thinking going forward? And maybe that rolls into rule number 8.
Yeah, it absolutely does. So rule number 8, and this is where some people want to try and accuse me of violating my own rules. So let me kind of speak to that. So rule number 7 is that forecasting is for weathermen. Rule number 8 is that excess is never permanent. So you are exactly right. It depends on which valuation measure you look at, but stocks are at their second or third highest point in the last 100 years. And valuations tend to be a horrible predictor of what's going to happen over the next 6 to 12 months, but they tend to be a very reliable predictor of what's going to happen over the next 5 to 10 years. Basically, expensive stuff tends to get cheaper and cheap stuff tends to get more expensive. And so, in chapter 8, I try and make the case that excess is never permanent, and that the truest phrase in investing is "this too shall pass." So, in 2008, as bad as things were, you have to tell yourself, this too shall pass. It won't always be this bad. And then after a year like this, when stocks are up 20%, you have to tell yourself, this too shall pass, because excess is never permanent, and you don't always get 8 years of, mid double-digit returns. And so I think the thing to say here is this. There's 2 things to say. The first is no one knows what's going to happen. Okay, effectively, no one thought Donald Trump was going to be the president. Effectively, no one thought that when he did get elected, that it would be this huge boon for the stock market. And effectively, no one predicted how well stocks would do this year. And so there's a lot of uncertainty, and forecasting is tough, and we shouldn't engage in it. But on the same hand, we know with a high degree of certainty that the kind of returns we're going to achieve over the next 5 to 10 years are going to be pretty crummy. I mean, just given where fixed income is, given where stocks are, you're just probably not going to get great returns for the next 5 to 10 years, which makes it extra important that you set aside money, that you manage your behavior, that you work with a coach, and you may need to make some adjustments like putting off retirement a year or 2, working a little longer, cranking up your savings a little more to meet your pro formas. But what I think it doesn't mean is that you take drastic action based on fear or based on an assumption that something big is going to happen. Because as we've seen over the last year or 2, those things are awfully hard to call.
That they are. I'm going to call Bitcoin. I think it's going to go down. I don't know when, but I think it's going to go down.
Bitcoin is just fascinating for me to watch. And, I'm a big believer in the technology underlying it, but I sent a tweet out the other day. I have invested, probably 100 hours now in the last couple of weeks, just trying to understand Bitcoin and the blockchain technology that underlies it. And I sent out a tweet and I said, at this juncture, I could make a very cogent case for Bitcoin going to 0 or going to 100,000. And there's just no way to know. And so, again, we'll segue to the next one. The next rule is diversification means always having to say you're sorry. So, I read a report on people mortgaging their houses, getting second mortgages and things so that they could buy cryptocurrency like Bitcoin. And diversification to me is sort of the lived experience of saying, I have no idea what's going to happen. So if you want to take 1% or 2% of your wealth and put it in Bitcoin because you're sort of betting on the come there, then hey, like whatever, because you're still diversified. But if you're mortgaging your house and sort of betting it all on cryptocurrency, even if it turns out well for you, you did a stupid thing. And so what I try to do here is separate process from outcomes. And so I think the best investors have a fantastic process, because people can get rich on Bitcoin and it still be a bad move if they're, borrowing money or getting a second mortgage or whatever. So to me, diversification is the lived embodiment of this idea that nobody knows what's going to happen. So we're going to spread our money around. And frankly, the always having to say you're sorry piece means that basically in almost every market, something is going to be down. If stocks are up, bonds might be down. If real estate's up, then stocks might be down. But we don't know and we don't care. We're going to diversify the heck out of it, and we're going to realize that we don't know what's going on, and we're going to maintain that humility.
One way you can do that for those of us who like to think we're smarter than we are and play around is to have a small slush fund. And within your slush fund, you can do all kinds of stupid and have fun, knowing that it's a slush fund. It means nothing. And even though it might be 10,000 or whatever, it's such a small percent of your overall wealth that you can have fun. It's kind of like going to Vegas and gambling, and win or lose, it doesn't really matter because it doesn't affect your overall outcomes.
That's actually great advice. And that's something that I do. That's sort of how I try and scratch my own itch for wanting to do some of these dumb things, is I do it in a very small way. I do it with whatever, 1% or less of my net worth. I'll set that aside. It's enough to play with. It's enough to have fun with and give you something to engage with capital markets on. But you're not putting your life or your family's lives at risk. I think that's great advice.
That is Rule 10. Risk is not a squiggly line.
Yes. Academic conceptions of risk are all about volatility. Academicians would say that the risk of an asset is comparable to its volatility, how much it goes up and down, right? For a lay person. But so I make the case in there that we need to be thinking about more fundamental types of risk. So one of those types of risk is behavioral. And we've talked about that a lot today. The other type of risk that we need to talk about is people running the risk of not having enough money to retire. People having to work right up until the time that they're infirm or they die because they haven't been aggressive enough. If you look at stocks versus bonds in rolling 30-year periods, right? If you look at rolling 30-year periods, stocks beat bonds 100% of the time in rolling 30-year periods, and they have an average return of over 7% real, so adjusted for inflation, versus just over 1% for bonds. And so we consider bonds to be much less risky than stocks because they're less volatile. But if you're in danger of not having enough money to retire, especially early on in your investing career, you need to be thinking hard about equities. And I'm not picking on bonds. I'm just saying it's a little bit silly here that we talk about an asset class that outperforms 100% of the time over the long term and does so with dramatically better returns as the riskier option when the average American has, when the average pre-retiree has only about $100,000 saved and is looking at average medical bills of about $250,000. I mean, when the average American hasn't even saved enough to cover his or her medical bills in retirement, the risk is not the stock market, the risk is us.
That is very true. It's funny because at this point in time, interest rates are so low, which means that bond prices are so high. As we talked about earlier, that excess isn't permanent. As interest rates go up, the price of your bonds is going to drop. And people who think they are in a safe investment may find themselves losing a lot of money if we go into a more inflationary time.
I saw something the other day that said the expected forward returns on a 60-40, 60% stock, 40% bond portfolio are the lowest they've ever been in basically the history of the U.S. market, just because of where interest rates are and the impact you talked about on bonds versus where valuations are with stocks. So yeah, I think now is a time for people to be very cautious, for people to not get caught up in the enthusiasm and the big returns of the last 5, 6, 7, 8 years, and to realize that now is a time for temperance, for hard work, for good behavior, because things are not likely to be all that rosy for the next 5 to 10 years. And we're going to probably need to do a lot of hard work and adjust our expectations, both about work and investing, if we're going to make it.
That was exactly one of the reasons that I got into real estate, to hedge, because when I started buying real estate, and even now, we buy severely undervalued properties. And with interest rates so low and being able to lock them in long term, it gives me an inflationary hedge. It takes me out of stocks and into a market where if I can get in at the right price points, gives me a bit more diversity.
One of the things that I think is cool, we look back, there's only been one 10-year period in U.S. history where you would have had negative returns in stocks, and it was the 2010, so the turn of the century there. You would have lost about 1% a year if you had invested in large capitalization U.S. stocks. But if you had a diversified portfolio of bonds, commodities, real estate, and you split it up between 5 different asset classes evenly, and you rebalanced it each year, you would have gotten about 7.2% a year for that 10 years. That's known as the lost decade in U.S. stocks. So even in the worst of times, usually something is going up. So if you are diversified enough and you're patient enough, I think you can have good outcomes. But most people, I think of diversification as having lots of different mutual funds of U.S. stocks, and that's hardly the case.
No, they all go down together.
That's true.
So what have you learned since the book came out and you've been out talking to people about it?
One of the things that I've learned is just how little people understand these things, and just what a steep hill we have to climb as financial educators to tell people about these things. But beyond that, one of the statistics that I cite in the book is that we lose 13% of our IQ under stress. So even if people read books like mine and come to an understanding of sort of the fundamentals of good investing, they're still likely to do the wrong thing at the wrong time. So we need that peer, that accountability partner, that coach, that advisor. We need a combination of education and hand-holding if we're going to do the right things.
Who do you see are the best handholders for the average person with regards to their money?
The checklist, I don't have the checklist in front of me, so I can't sort of run down those 10 things off the top of my head. But 2 things that I would look for, the first is, are they a fiduciary? Ask them that. Are you a fiduciary? Because a fiduciary is not the salesperson that you mentioned at the top of the show. The fiduciary has a legal mandate to act in your best interest. And then the second thing that I would look at is just something as simple as rapport. Like, how much do you gel with or click with that advisor? Because ultimately, that's going to be a good predictor of whether or not you take their advice. You don't maybe want the person with the slickest hair or the most expensive suit. You want the person who you care about and you click with such that you're going to listen to their advice even when it hurts.
And so you have some other interesting research. Why should we men let our wives run our investment portfolio instead?
So there's a lot of great research about how women who only make up about less than a third of the financial services industry are a lot better at managing money than men. And so there are a number of reasons why this is the case. John Coates is a researcher. His book, I'm going to get it wrong. His book is called The Hour Between Dog and Wolf. It's a really interesting book on risk and hormones. And so, one of the reasons that men are worse is biological, just sort of the overabundance of testosterone we have. He makes the case that this makes us bad investors, makes us sort of overly aggressive and overconfident. The second thing we found is that women are better at weighing probabilities. Third thing we found is that women are more patient, which is not super surprising to me, just when I observe my own behavior versus my wife's behavior. But yeah, so women are more patient, they're more prudent, they're better at weighting probabilities. And retail investors, so sort of mom and pop investors, women outperform men, all the way to hedge funds. Women run hedge funds tend to do a lot better than male run hedge funds. So there are reasons, psychological and biological, why this is the case. We need more women in finance and in asset management. So if you're listening to this and you're interested, the industry needs what you've got. So come on.
Thank you for that call out for them. So at the end of the day, it really comes down to one thing, I think, and I truly believe this. The biggest obstacle in our success is the reflection in the mirror. How do we overcome ourselves? And I think it doesn't matter whether it's money or any other part of our life. Do you have any advice for that?
Yes, overcoming ourselves is a mixture of, we'll call it a mixture of Rule 5 and Rule 1. So you're not special and you control what matters most. The first thing that we have to tell ourselves is just that we are prone to the same errors as the next person. And that's very hard for us to do because we are almost all, research shows, we are almost all overconfident. We tend to think of ourselves as smarter and better looking and better drivers and funnier and better friends than the next person, when that's, of course, statistically not always the case. One of the things that we have to do, and it's very tough for us to do, is consider ourselves average. For some of us who have made lots of money or have had some professional success or have gone to lots of school or whatever, you're used to being successful, and you have to understand that what got you there won't get you to where you want to go in the stock market. So just understanding and owning that you're average is an important first step. Beyond that, when you own that you're average, sort of paradoxically, really above average things can start to happen because you let some of this illusion of control fall away. You let this idea that if you watch CNBC enough, you're going to get all the right moves and all the right ideas fall away. This paradoxical thing that in owning your own mediocrity, you really set yourself up for excellent financial success and a really extraordinary life, but only when you admit how ordinary you are.
And that's tough to do.
Very tough. We're programmed to have sort of a padded ego because that's what gets us out of bed in the morning, but we got to let it go in the market.
And so I'm going to take this a slight different direction as it applies to kids, because I just saw something today that was kind of interesting. And I think you probably read Carol Dweck's book, Mindset. Mm-hmm. And she talks about raising kids. And one of the things that they talk about in there is, as a parent, when you tell the child that they're special, it creates a fixed mindset and they don't want to try things because they're afraid of not being special. Whereas if you tell them that the hard work got them the result, then it creates more of a better mindset that pushes them forward. Now, I just read today that they did some studies in low-income schools, and they found that it was kind of the opposite. And it was because the kids didn't want to do hard work, but because they were special by coming to school, that's what got them in the door. And so when they told them the opposite, which she was mentioning, it kind of turned them off. And so I guess we humans are kind of messy in all of this. And I don't know if you read that or if you have any thoughts.
I read her book and I'm aware of some of the critiques of it, like you mentioned. I will say that some of this is domain specific, which means it works in some places and not others. And I'm, of course, speaking directly to its application in financial markets. So I think having a little bit of an inflated sense of self is good for society because it makes people happy. It makes people resilient. It leads them to do things like start restaurants. I mean, starting a restaurant, I love going out to eat. I'm a big foodie. Starting a restaurant is on paper always a bad idea. Just speaking probabilistically, starting a restaurant is a low percentage shot. And yet I'm glad people are overconfident enough that they take that on because I like to go out to eat and it's good for society, right? So I think that while overconfidence or, having a sense of ego or specialness is good in certain domains, it's absolutely good. But I would also tell you it has no place in investing because it leads to people doing things like what I saw at a recent conference. A gentleman came up to me afterwards. He had a couple $1 million. Half of it was well diversified and half of it was in Apple stock. And he said, hey, Dr. Crosby, you're an asset manager. What do you think is going to happen to Apple stock? And I said, it doesn't matter if it goes up 300%. What you're doing is dumb. What you're doing doesn't make sense because he thinks he's impervious to the things that happen to stocks sometimes. We have to eradicate this sense of specialness at every turn in financial markets, even if it is pro-social, positive function elsewhere in society.
Absolutely. By the way, do you know how to make a restaurant that's worth $1 million?
Start with 2?
Start with 2 million, exactly.
There you go.
That's the joke in the restaurant industry. I did that when I was a kid, and people don't realize 96% of restaurants go out of business within 5 years. I think 80% in the first year or two. Yeah. The odds are horrible. And so be careful with that. Is there anything that I missed today that we should touch upon?
No, I think you're very thorough. We've had a wide-ranging conversation. It's been great.
Thank you. And I appreciate that. If people would like to connect with you, where can they find you and connect?
I hope they'll check out the book, The Laws of Wealth, get it on Amazon or at fine booksellers everywhere. You can find me on Twitter at Daniel Crosby. And I'm also very active, posting a lot on market psychology on LinkedIn. Daniel Crosby, PhD on LinkedIn.
And I encourage you all to connect. It's a pleasure having you here. Thank you so much for joining us today.
Thanks so much.
I encourage you to check out Daniel Crosby's site and read his book, The Laws of Wealth. I have a link to the book on Amazon in the show notes. Clearly, where you focus your attention is where you get results. By being clear on money, Daniel's family has had financial success across multiple generations. I know for me, if I had a financial coach, it would have resulted in over $1 million of increased net worth, if not more. Will you get the same results? I don't know. It depends on who you are, what income you have, and what skill set and goals you're trying to achieve. This is why I'm so passionate about coaching, because I see the 7-figure value and results over a lifetime from this type of behavior coaching. What's preventing you from moving forward? And who are you putting on your team to help you build the life you deserve? Taking no action creates a far worse outcome in life than trying something and failing. Today's action step: start having money conversations in your family and look yourself in the mirror and answer those questions. Is there someone you know who should start having money conversations? Please share this episode to help them. They'll appreciate you for it. Thanks for listening. You can contact me at Rocky at richersoul.com. Have an abundant week.